Neil, just a point of information for me. Are you related to Eldon Dirks?
No, but I grew up in the same neighborhood.
Eldon's a dear old friend of mine who, he'll hate me for saying this, but was one of my mentors in agricultural credit. So it sounds like Eastern Iowa.
Yes, Commissioner, I grew up about 2 miles. His brother was my school bus driver, so.
Harry, are you prepared? All right, if you will kick it off, greatly appreciate it.
Thank you, Commissioner Dunn, Chairman Gensler, and fellow commissioners. Today I will discuss some observations in livestock markets related to price reporting and industry trends. My comments will focus on the hog market specifically. I prepared these comments and the views are my own. The USDA's Grain Inspection, Packers, and Stockyards Administration are here as well to comment on this trend, and the Agricultural Marketing Service is here as well. And I believe the Chicago Mercantile Exchange is on hand next to talk more specifically about the contract itself. I will begin with a very brief description of the futures contract and how it's connected to the cash market. I'll then have a very brief description of the connection between the cash and futures market, but also I'll highlight some outlier situations and market transparency issues and how those issues relate to surveillance concerns. Finally, I will conclude with some discussion of industry trends, some concentration issues, and a reference to an academic study related to these issues. The very next slide here is a screenshot of the 201 report. This is a USDA AMS report from which the CME derives the values that they use for their lean hog index calculation. It's a 2 to 3 page report. There's a lot of information on this report, but I've highlighted the 6 cells that the calculation uses. And as you can see, it is what they call a producer sold negotiated and producer sold swine or pork market formula variables. There's a head count, there's an average net price, and an average carcass weight. These numbers are multiplied each day. They get a value for one day, they have a value for another day the next day, and those two are combined together. I think the CME can get into more details and questions about that. But what I do want to highlight from this screenshot in this report is that it's a daily transparent report, but you can see there's a big difference between the total head count in the negotiated category compared to the SPMF category. And that is something I think that we'll see a little bit more detail later on. But it is important also to note here that these are net prices. These are prices that are derived from hogs that have been delivered and have been slaughtered. And I'll get a little bit deeper into that later. And one final point from this slide is that in the SPMF category, it's industry practice for packers to buy hogs using long-term contracts. And each day, a certain undetermined percentage of these contracts use the Western Corn Belt or the Iowa Southern Minnesota negotiated base price as their reference base price. And we'll get into that in the next slide here. This is the Western Corn Belt USDA report. It's an afternoon report. It's actually a report for July 30th. Lower down on the screen, you can see that this is one of the more referenced prices and head counts in the industry. I've highlighted there that it's barrels and gilts on a carcass basis. The head count on that particular day was 4,953, and the base price range that day, that's a range of obviously highs, lows, and a weighted average middle price. The range that day was 75 to 83.78, roughly $8.78, and the weighted average was 81.49. The cash hog market generally trades and reports trades using these base prices. Again, the CME uses net prices for the index, but the cash market trades a base price. The base price becomes a net price when the hogs are delivered and slaughtered. Each net price is determined by the base price and the packer's grid or matrix. Each packer has a different matrix because each packer values different hog attributes differently. These attributes are weight, target weight, leanness, and just general yield of the animal. So each packer has his own value for those. As the hogs are processed, this base price becomes a net price. The net price accounts for the hog's yield and determines what the hog seller gets paid. The CME, again, uses these net prices to calculate their index. Before we leave this slide, I'd like to make a couple of quick points about the negotiated market. The negotiated market are spot transactions. The hogs are to be delivered within 14 days. There are some other rules, but I'm just going to highlight a few. The transaction sizes in the negotiated market can be quite large. And as you can see, the head count on this particular day on this particular report was roughly 5,000. But one of the other attributes of a negotiated transaction is that negotiated transactions can be canceled after being reported. So in other words, the price and the head count could get into this report, but the transaction could be canceled and never been delivered. And packers also have choices on where to purchase negotiated hogs and how and when to report the prices. This is an afternoon report. It compiles some of the prices and head counts from a morning report, and then later on there's a full day report. So there are different times and cutoffs from which packers can choose to report. And prices can also be reported on either a live or carcass basis, and that's kind of a real deep in the weeds type characterization, which we can get into later, but the point I wanted to make is that it is a choice. The next slide here shows hog procurement and pricing methods using that 201 report that I used on my third slide. It's kind of a summary of the head counts, how they've changed over time. Note that the producer sold category is decreasing, and most notably the negotiated category is dropped off quite significantly. Currently the negotiated category is about 5.5% year to date for 2010. Also note that the packer-owned category is increasing. Further note that as currently reported by AMS, there are a lot of hogs in the 201 report that are not included in the CME index. The next slide uses those two categories of SPMF and negotiated. It boils out just those two categories in terms of how they've changed over time. This graph shows each category's percentage of the head count that went into the lean hog index calculation. As you can see, the SPMF went from 78% of the head count in 2003 and is now about 91%, and the negotiated category was 22% and is down to 9% currently. Slide 7. This slide breaks into the cash transaction side. We're into talking about purchase data right now. This is the Western Corn Belt 212 report. It's the afternoon report, as I mentioned, and this is kind of a medium-term graph on the range. The purchase report information, it shows the high, the low, and then the weighted average of the day. A point from this slide would be that the weighted average tends to be near the high of the day. Again, it's a weighted average. It's kind of a special concept here in this type of reporting. But from the surveillance perspective here, we always see that there's a range and that there is a low. So we take note of that because on a day where the range is the weighted average is near the high. In surveillance, we see that there's always cheaper hogs available. Slide number 8 takes that range from the Western Corn Belt, goes a little farther back, and does a 10-day moving average of that. The graph shows the 10-day moving average of the range, and that range tends to be about 10 to 15 cents per hundredweight. The graph also shows a period of outlier ranges, periods where the range exceeded 15 cents and was as wide as 20 cents per hundredweight. Periods of sustained wide ranges can lead to surveillance or transparency problems. On such days, hogs appear in great supply on the low end and in very short supply on the high end. This is the Western Corn Belt range. It's not a range from the national report. Now, an example of this range, if you take 20 cents as a range, as an outlier, if hogs are trading roughly 40 cents or $40 per hundredweight, a 20-cent range, if you split it, means that hogs are trading as low as 30 or as high as 50. If you're buying hogs at 40 and your next purchase happens to be at 50, that's a 25% increase just in one transaction. So these outlier situations, again, lend themselves to some surveillance concerns. Slide 9, again, uses the Western Corn Belt purchase data, but compares it to something else. It's called the carcass cutout. This is really essentially the USDA's estimate of the value of pork. The graph shows what could be called a packer margin because it's the price of the product, which is the pork, minus the cost of the input, which is the hog. Up until about February of 2008, the cost of hogs rarely exceeded the price of pork. So then you can see there was a sustained period where the cost of the hog was more than the value of the pork that was being sold. And I think there's been some recent developments in terms of the reporting of pork prices. Previously, or currently I should say, the reporting of pork sales is not mandatory, but I think one of the drafts of the new Farm Bill, or one of the new suggestions, which I think Warren might mention, is being proposed that pork price reporting become mandatory. So this is a situation that was in the past that could remedy itself in the near future. Slides 10 and 11 kind of get into some concentration issues. This is a pie chart of some of the larger packers in the industry from estimates that we took in 2009. I think Mr. Johnson, Packers and Stockyards, has some comments about this, so I'll be brief on this slide. As you can see, the names of the major participants are Smithfield, Tyson, Swift, Cargill, and Hormel. And of those big 1, 2, 3, 4, 5 packers, I believe Smithfield they all have some degree, I believe, of vertical integration, but I think Smithfield has the greatest percentage of vertical integration. And again, this is slide 11, shows how the farm firm concentration has changed. Other than some of the statistics that Mr. Johnson will mention, I would add to this slide that in 1997 is when the CME first listed the lean hog index futures contract, and there's been some significant changes in the four-firm concentration since then. But before I defer to Packers and Stockyards, I would like to make one final reference to the following. In the fall of 2009, there was an academic study by Gomez, Frank, Kunda, and Garcia, which was published in the fall 2009 Review of Futures Markets. It was published by Kent State University. Academics, as well as the public, have taken note of the recent cash price reporting outliers, as well as the industry concentration trends. This study highlighted an increase in the basis variability of the cash hog market relative to the lean hog market. The study compares basis behavior, basis forecasting, and marketing strategies for both physically delivered hog futures and cash settled hog futures, the difference between the two regimes, the physically delivered and the cash settlement period. They concluded that, among other things, and I quote, basis level and variability increased in the cash settlement period, end quotes. The study also finds, again, opening quotes, the use of futures generally reduces the variability in cash prices, but it's the ability to do so that has declined during the cash settlement period due to an increased basis variability, close quotes. The study suggests that a possible cause of this behavior is the shrinking negotiated market and these industry concentration and vertical integration trends. And those conclude my remarks, and if there's any questions specific to the slides that I presented, I can take those. If not, we've got Jay Johnson here from the Packers and Stockyards Administration.
Thank you, and Jay, welcome. Jay and I had worked very closely in the past when I was Undersecretary for Marketing Regulatory, as with Warren. These are two guys that I have a lot of trust and confidence in, and I really appreciate them being here. And I note that Chris Sarcone from Ag Marketing Services here from Public Affairs. So I appreciate USDA sending us their very, very best here. And with that, gentlemen, if you would give your presentations.
Okay. Thank you, Commissioner Dunn and your fellow commissioners, for inviting the Grain Inspection Packers and Stockyards Administration to join you today to discuss the structural issues in the pork industry. An examination of the pork production sector shows that producers raising more than 5,000 hogs per year produced 61% of the market hogs in this country. Producers raising more than 2,000 hogs per year produce 85% of the hogs. We have some truly large producers in this country. In 2009, the top 10 producers owned approximately 2.3 million, or 40% of the nation's sows, that raised about 46 million pigs. The top 20 producers have 2.8 million sows, or about 48% of the nation's sow herd. Successful Farming Magazine's annual survey of pork producers shows that Smithfield Foods in Smithfield, Virginia was the largest producer in 2009 with over 922,000 sows, which represents about 16% of the U.S. herd. Triumph Foods, St. Joe, Missouri was second with 371,500 sows. Seaboard Foods, Shawnee Mission, Kansas was third with 213,600. And Iowa Select, Iowa Falls, Iowa was fourth with 152,500 sows. As a point of reference, each sow produces about 19.5 pigs per year. The top 3 hog producers are also included in the list of the top 10 pork slaughter firms. Currently, the top 4 slaughter firms have a market share of approximately 65%, or also known as the 4-firm concentration ratio. In alphabetical order, these firms are Cargill, Smithfield, JBS Swift, and Tyson Foods. The hog slaughter industry has become significantly more concentrated over the past 30 years, with the majority of the structural changes resulting from mergers and acquisitions in the industry. In 1980, the 4-firm concentration ratio, which measures the total market share of the largest 4 firms in the industry, was 34%. By 1990, the ratio rose to 40%, and then to 56% in 2000. By 2003, the 4-firm ratio had risen to 64% and has remained relatively steady since that time. Pork production and slaughter is very geographically concentrated in the Corn Belt, as well as in the Mid-Atlantic region, which is comprised of Virginia and North Carolina. There are other isolated areas of production in Pennsylvania, Utah, Oklahoma, and Texas. Probably the largest change in the hog industry in the past 15 years is how hogs are marketed. Today, a very large percentage of hogs are sold on a formula basis or other type of purchase arrangement as opposed to on a negotiated basis. In 2009, formula or purchase arrangements accounted for 62.2% of all hogs slaughtered. Most of the hogs sold with a formula or purchase arrangement are committed via long-term contracts. The formula basis hogs generally use a publicly available price series as a basis for determining their price. The most widely used is the Iowa Southern Minnesota Afternoon Report. The popularity of contracts increased significantly after the collapse of the hog market in 1998 and 1999. During the period, prices were as low as $8 a hundredweight because there was not sufficient slaughter capacity to handle the supply of market-ready hogs. As a result, many producers were determined not to ever get in a position again where they did not have an assurance of shackle space to handle their production. By entering into long-term contracts or agreements, producers are guaranteed shackle space by the packer, and likewise the packer is guaranteed a supply of hogs. A couple of plants were even opened by producer-owned cooperatives after that time. In addition, the number of packer-owned hogs has increased from 19.5% of all hogs slaughtered to 31% in 2009. Currently, approximately 3% to 7% on a weekly basis of all hogs marketed are on a negotiated basis. Of this amount, approximately 1/3 are sold on a live weight basis and 2/3 on a carcass weight basis. In 2002, the number of hogs marketed on a negotiated basis was approximately 15%. In concluding, once again, I'd like to thank Commissioner Dunn and your fellow commissioners for allowing GIPSA to come before you today to discuss the current structural issues in the pork industry.
Thank you very much, Jay. Warren?
Thank you, Commissioner Dunn, and I appreciate the confidence that you have in us. I've had to edit my remarks here, and I'm no longer going to say good morning, Commissioner Dunn. I'll say good afternoon, Commissioner Dunn, your fellow commissioners and members of the Agricultural Advisory Committee and all the guests. I appreciate the opportunity to represent USDA's Agricultural Marketing Service at this meeting today. If you may recall, in 2006, I had the privilege to speak before this committee in a similar meeting on the role of price discovery markets and USDA programs during a session on the economic and market implications of thinly traded price discovery markets. It seems that we've returned to that same theme today. In the meantime, Negotiated cash trade on the markets that we report continues to become thinner, as evidenced by decreasing percentages of negotiated spot or cash market trades. My purpose here today, though, is not to speak as an economist, but rather to provide an overview of how we at AMS provide price transparency to the marketplace through both voluntary and mandatory livestock reporting programs. USDA's Livestock and Grain Market News consists of about 24 field offices with about 75 federal market news reporters. Our livestock mandatory reporting program is carried out in 2 of those offices, Des Moines, Iowa, and St. Joseph, Missouri. For our voluntary programs, we also have cooperative agreements with 29 states through which we train and supervise about 130 market reporters employed by those states. These cooperative agreements enable us to leverage our resources to provide greater breadth and depth for livestock and grain market reporting, particularly at auction markets that might be of primarily local or regional interest. However, continuing state budget shortfalls are threatening these state-funded programs. In 2008, for example, Wisconsin terminated its state market news program, and as a result, we no longer provide coverage of livestock auctions in that state. As we monitor this situation, we'll continue to deploy our resources to provide priority for markets of regional or national interest. One of the most important roles for our supervisors for our voluntary market news program is to ensure uniform reporting of the commodities that we cover. For the voluntary side, this means that we provide continual training on live animal evaluation. For example, when a state or federal market news reporter covers an auction market, we want a feeder steer reported as a large frame number 2 thickness animal to represent the same characteristics, whether that steer is reported at an auction in the far southeastern part of the country in Florida or in the far northwestern part of the country in Washington. That way, when reports are compared across regions or over time, users have the assurance that the categories of animals reported are similar in terms of class and grade. Our mandatory reporting program operates quite a bit differently than our voluntary programs. The Livestock Mandatory Reporting Act of 1999 was enacted in October of that year, and the first reports under the program were released in April of 2001. Under the mandatory reporting program, larger packers are required to report their transaction level data to us on cattle, hog, and sheep and lamb purchases, as well as box beef, box lamb, and lamb carcass sales. And as Harry mentioned, wholesale pork cuts are not currently included as part of the mandatory program. Larger lamb importers are also required to report to us their lamb imports. Processing plants slaughtering at least 125,000 head of cattle or 100,000 head of hogs per year required to report livestock purchase information to us, as well as packers that slaughter at least 200,000 head of sows and boards regardless of individual plant size. In all, we have about 115 establishments that report to us under this mandatory program. Plant slaughtering steers and heifers report purchase transactions to us at least twice a day, and plant slaughtering barrows and gilts report purchases at least 3 times daily. There's also some weekly reporting and some additional daily reporting that sometimes bumps those numbers up on particular days. Under the mandatory reporting program, within 1 hour following the data submission deadlines, we validate the data received from packers and lamb importers to prepare and disseminate over 100 daily, weekly, and monthly reports. These published reports cover an estimated 77% of slaughter cattle, 93% of box beef, 95% of slaughter hogs, 60% of slaughter sheep, 41% of box lamb, and 26% of the carcass lamb markets. Each entity required to report under livestock mandatory reporting is audited at least twice a year. Our auditors examine randomly selected transactions to ensure that the information is reported to us correctly, timely, and completely. Tabulations of the results of our compliance visits are posted quarterly on our website. And beginning in 2009, we also began posting monthly summaries of excluded transactions. These are transactions that would be omitted from our public reports at the discretion of our market news reporters. For example, in the process of validating transaction level data, a reporter may mark a transaction to be excluded from publication for price aberrations notably lower or higher than the bulk of the market due to discounts for premiums for weight, quality, yield, dressing percentage, inferior livestock or mixed classes of livestock in the same lot. A review of our excluded transaction summary shows that few transactions are omitted, and when there are transactions excluded, the impact on our weighted average prices is minimal. In addition to our standard published reports, we have launched 2 new items to make our information more readily available and easy to understand. First, we now have a growing number of reports that are formatted for mobile devices such as cell phones and PDAs. Users who subscribe to these reports receive concise summaries of key information from some of our most popular reports. And I have a little cards here if anyone's interested to pick up that tells you where to go to sign up for the mobile reports. Secondly, just in the last month, we released our direct slaughter cattle reporting dashboard. This dashboard was created as a result of a directive to the Secretary from the 2008 Farm Bill. And this interactive tool enables users to visualize key cattle market information in charts and tables that can be customized and easily downloaded for further analysis and presentation. Links to both the mobile reports and the cattle dashboard can be found in the livestock and grain market news section of the USDA Market News portal at marketnews.usda.gov. On a final note, I'd like to make the committee aware that the Livestock Mandatory Reporting Act does expire on September 30th of this year. Bills have been reported by both the House and the Senate Agricultural Committees to renew the statute for another 5 years. The House and Senate bills are identical, and in addition to reauthorizing mandatory reporting, they would also require mandatory reporting of wholesale pork cuts and add weekly pork export reporting, as well as require electronic reporting to conduct the mandatory dairy product information reporting program. We believe that continuation of the livestock mandatory reporting program and the addition of wholesale pork reporting to the program are important to provide transparency and full information to all market participants. Thank you for your time, and I will welcome any questions that the Commission or the Advisory Committee may have.
Thank you, Warren. I must say that Harry and I have discussed the new dashboard, and it's really a great new asset for all of us to use. And so kudos to you and the department in putting that up. Mr. Peterson, could you comment on the CME groups and how this affects your contracts, please?
Certainly. Thank you very much, and we appreciate the opportunity to be here. I was asked to actually cover, in addition to the hog issues that Harry outlined, to cover the other livestock areas. So I've got quite a bit of material to cover, so I'm going to go through it rather quickly and would be...
We do have your written pieces. And
Yes, you do.
And
Yes, you do.
If we
So-
could, if you could hit the high points, that would be
I will hit the high
appreciated.
points. I
Thank
will
you
do
very
that.
much, Paul.
Okay. Okay, and Harry, you're going to drive. Okay. Okay. Just by way of background, CME offers futures and options contracts on 3 major classes of livestock: live cattle, which is slaughter weight steers; feeder cattle, which are partially grown steers, which are destined for a feedlot where they will be fed to slaughter weight. So that's sort of an intermediate category. And then lean hogs, which is slaughter weight barrows and gilts. I especially want to highlight the difference between live cattle and feeder cattle. That always seems to lead to a lot of questions. Originally, all 3 of these contracts were virtually clones. They had almost identical contract specifications, and that's because when the live cattle contract started in 1964, when the plans came to start what was then the live hogs in 66, they simply took the live cattle contract and used that as a template. Likewise, when feeder cattle came along in 71, that served as the template once again. But over the years, because of differences in these different markets, it was necessary for those contracts to diverge, and today they are all substantially different. Only live cattle is still physically delivered. Both lean hogs and feeder cattle are cash settled. However, all 3 of these are highly dependent on the USDA AMS data and personnel. Briefly, to go through the live cattle, as I said, it's a live delivery process. Par delivery unit is 40,000 pounds of steers. Final settlement is by physical delivery in two methods. They can either be delivered to a live to one of 13 delivery points where they're graded by market news personnel, USDA personnel, or they can be delivered to one of 15 packing plants where they're graded by meat grading personnel, both under USDA. The interesting point in live cattle is that the value of each animal or carcass is determined using published market-based premiums and discounts published by USDA Market News. From these we get the quality grade differentials for prime, choice, select, and so forth, the yield grade differentials for yield grade 1, 2, 3, 4, 5, and also for carcass deliveries at the packing plants we also get differentials for light and heavy carcasses and condemned livers. So the result is virtually any steer within the allowable weight range is deliverable, and this whole valuation process, while it may seem rather complex on the surface of it, it's actually consistent with the grid or value-based marketing processes that are widely used in the cash market for slaughter cattle. These various premiums and discounts come from a variety of USDA reports. I've detailed that on, I believe it's slide 6 of your deck. With the information that comes from each of those reports, so I won't belabor that point. In short, this has been a very successful process, and volume has grown. Recently, actually I believe it was in May, we set an all-time record for volume and also had record open interest as well. So that's all been very encouraging. Shifting to feeder cattle for a moment, here's one where final settlement is by cash settlement to the CME Feeder Cattle Index. Feeder cattle futures, that is actually the oldest cash settled agricultural contract. It was converted to cash settlement way back in 1986 when physical delivery proved to be unworkable. In the case of feeder cattle, the cash settlement index, it's calculated by the exchange. There you go. It's a 7-day weighted average price. In other words, total dollars divided by total pounds. It's calculated from all auction, direct trade, video sale, and internet sale transactions that are reported as weighted averages by USDA AMIs from a 12-state region, and those states are listed below. This index is designed to reflect a broad cross-section of cash market transactions for feeder steers. During the fall and spring time when we have the peak marketing runs, the index includes reports from approximately 120 locations in these 12 states. And this is on a week because the feeder cattle transactions, the feeder cattle auctions tend to occur on a weekly basis. So it's a once-a-week affair. Therefore, we have a 7-day index so that as new information comes in, old information drops out. In 2009, this covered almost 1.6 million head that were used in that index calculation. These are voluntary reports. Earlier, Warren made the distinction between mandatory and voluntary. These are voluntary reports for the simple fact that the mandatory reporting system is set up to capture information collected from packers. Since these are the intermediate stage, they haven't yet made it to the packing plant, it's necessary to collect this on a voluntary basis, and that's done by the market reporters at auction facilities and various other venues. We use a transparent calculation process. Again, it's performed by exchange staff. We post the results on the CME website each day with a complete calculation along with a long history of historical data. And there's a surprising number of individuals who conduct parallel calculations and basically double check our figures. So it's a very transparent process, open and easily reproducible. Looking at the average daily volume and open interest, you can see the seasonal patterns in marketings are matched by the seasonal variations in volume. And on the open interest, we've seen a recent upswing in open interest. Finishing up with lean hogs. Here again, this is a cash settled contract. This one settled to the CME Lean Hog Index. This is the largest cash settled agricultural contract. We converted to cash settlement in 1997 in response to some structural shifts in the hog industry. These shifts included a big move towards carcass basis pricing rather than live animal pricing. In addition, we were losing our delivery facilities. We had had a number of terminal markets close, and because the industry was moving from sales through terminal markets or buying stations to sales direct to packers, that movement to a terminal market was actually taking hogs out of their normal market flows. This was inefficient, and it was clear that we needed to move. So the result was conversion to cash settlement in 1997. We have made a number of improvements and adjustments to that since 97, which I'll talk about in a minute. But basically the lean hog index was modeled after the feeder cattle index, but with several important changes. It's a 40,000 pound contract, keeping it consistent with the old live hog contract. But in terms of the calculation, here is a 2-day weighted average. 2-day rather than 7-day, because the hog market is much more volatile, and we did not want it to be burdened by some stale prices or other outdated information. As Harry indicated, we use net slaughter prices. This is not the base prices that he talked about. These are net slaughter prices that include all premiums and discounts. So this reflects the final payment by the packers to the producers. So this is and it's for barrows and gilts. We use negotiated and swine and pork market formula transactions from that 201 report that he put up earlier. The reason we use those two categories is those are the two that are best and best suited for this process, and they also represent the cleanest sort of data. These represent approximately 50% of all the hogs marketed, and there are some good reasons not to include some other categories in there. For example, packer-owned hogs, which I believe were something like 31% of the total. That's not an arm's length transaction, so that's not something that we would want to include in the index. The index is, again, designed to reflect final payments from packers to producers, and it's, again, a transparent calculation process performed by exchange staff. All the results are posted each day on the website, and it's a totally open and reproducible process. I would also add on all of these cash settlement calculations, the hogs and the feeder cattle, as well as the reports that we use for the live cattle delivery adjustments. We pull those down from the USDA AMS website just like everybody else. There's no special arrangements. We don't receive any non-public information from them. We go in and grab them off the website just like everybody else does. So it's consistent across the board. In terms of volume, volume has recovered recently. We were up 15% for the first half of 2010 versus the same period a year ago. There was a very nasty drop-off, you can see in the middle of that chart on page 16, and that was largely traceable to this very ugly collapse in the hog market. Neil is nodding his head. It was just a brutal period for a couple of years, and that really hurt our volume. But fortunately, things have turned around and are on the upswing, and we hope it continues. Likewise, on the open interest side, you can almost see where the bad times hit on page 17. Things dropped off dramatically, but have been on the upswing. So just in summary, each of our 3 livestock contracts and the final settlement processes we use are different. These reflect the unique needs and differing cash market practices of each commodity. All 3 of them are highly dependent on USDA AMS data and personnel, whether it be for grading or for cash settlement purposes or for other adjustments. CME Group is one of many consumers of these data. We are not a producer of the data, we are a consumer, and these data are used to create the indexes on which these contracts are based. And finally, the underlying livestock markets have detailed data on actual transactions. This is a big difference from, for example, the grain markets or the cotton markets. I think we heard today that how difficult it is to get anything besides elevator bids or truck bids or things like this. Here we have actual transaction data, actual dollars that change hands between buyer and seller, which gives you a much better, much more accurate measure of actual economic value. And as a result, these are, because of the better price data, as well as the wide coverage that we have, the wide geographical area and the different categories that these can be divided up in, we have a high degree of detail, which is extremely useful in monitoring contract performance. So with that, thank you for your time, and would be happy for any questions.
Thank you, Paul, and we will have some questions, I can guarantee.
Good.
If we can now move to Don Close to talk about the perspective from the Texas cattle.
Good afternoon. Commissioners, remaining council members, thank you for the opportunity to be here today. So my role with cattle feeders is market director, and the Texas cattle feeders represents cattle feeders and feed yards in the Texas, Oklahoma, and New Mexico feeding area. Our members will market just over 5.5 million cattle annually. That represents just under 30% of the fed cattle supply in the United States. A primary service that my group provides to our members, we start off each Monday morning and we will canvass members to get an idea from them of how many cattle they have on their show list and their formula list each week. We will compile that data and have it reported by 10:30 a.m. Central Time on Monday mornings, not only to our members but to the wire services. And that total will, on a typical week with the two different sources, will be between 75 and 100,000 cattle. Initially, when those numbers are released on Monday, we will start canvassing our members of what their communication is with the packer buyers as they get to their feed yards and evaluate their show list every week. And when they start to bid on cattle, we assimilate that information and turn it around to our members as rapidly as possible. That goes on to whenever in the week that trade starts to take place. Once trade is started, we have members calling in, reporting to us both the volume of cattle traded and the price, and we will turn that information around as rapidly as we can. And so in a typical week, cash trade may last between an hour, hour and a half, and to get that volume of cattle reported in that time, it's a very active period in our office, I can tell you that. But once that's done, we then will, at the end of the week, we will total how many cattle have been sold and marketed, and we will match that against that initial show list to show just what our carryover is at the end of the week. Now, I think there's 2 points to going through all this detail. The first is I think it clearly demonstrates that the price discovery process is alive and well. The second part of that is our service is probably the closest replication to the AMS mandatory system that is out there. And I can attest to the fact that at the end of the week, our cash price and that reported by AMS will not differ by more than 1 to 3 cents per hundredweight on any given week. So we're using that as a benchmark number, and it's extremely tightly correlated. Before I go on, with the AMS group, Mr. Preston, the branch office in St. Joe, the meats office in Omaha, and all the field offices, I want to give them every compliment. They are extremely cooperative and working with us and answering any questions that we have and working with us in any way they can. When you look at the mandatory price reporting service, I certainly don't think that any issues with the mandatory is due to a lack of information. Nor do I think there are issues with the timeliness with the twice-a-day reports we get from packers. I think they're handling an enormous, mind-boggling amount of information, and they get it turned around at breakneck speeds. I do think that we can see some modest changes and recommendations that would make the system more transparent, make it somewhat more user-friendly. And with those, I would like to go in that we would like to see a report created that shows daily the intentions of all non-cash traded cattle that are committed for slaughter for at least 7 days forward. This report would be a replacement for the existing system that shows intended to show forward supply of the all cattle committed, all cattle delivered system. That's it's just so aggregated, it's difficult to pull out the detail that we're trying to get. We would like to see AMS provided with the flexibility to request additional information as needed and on a timely basis and largely seasonal. Two examples of this would be currently with the cattle from imported from Mexico, our members are having to sell those cattle at a $40 head discount. We would like to see the question picked up is it a Mexican or a Canadian animal? And in turn, if that is true, what is the discount? Another good example would be seasonally, typically in the spring, with the Japanese deal, we'll have a problem with some 30-month cattle, and when we get into those 30-month cattle, they'll trade at a typically about a $15 hunter discount, but that price varies. But those are two examples of how just a little bit more information on that Packer questionnaire each day could provide our members significantly more detail. We would like to see the transfer of responsibility to collect the retail price scan data to AMS and provide them with adequate funding to collect and analyze and report that information. I will remind this panel that retail scan data was originally part of mandatory price reporting, and it fell between the cracks along the way, and that's very valuable information to us in measuring that relationship of farm to retail prices. We'd like to see remove the existing category in the premiums and discount schedule. It currently reads carcasses weighing in excess of 1,000 pounds. We would like to make a small change there and have a category of 1,000 to 1,050, and then carcasses weighing 1,050 and over. There's two reasons there. One is because of the current live weights and yields on these cattle, we can have 1,000 to 1,050 carcass that's a legitimate carcass. If he gets over 1,050, he really falls outside the grid. So it impacts our cash market, but it also affects the delivery process with the CME. So that small change would make a big improvement. We would like to see...
Just a point of clarification here, and Paul, CME does periodically change its weights, is that?
Yes.
Yes. In fact, we just recently changed them for the October 11 and beyond. So yes, we change them periodically based on market trends.
And I would further share that Paul was in communication with us and asked for our input when they made those changes. We'd like to see developed through USDA can collect, analyze, and report market price data relevant to mandatory country of origin labeling for feeder cattle, live cattle, wholesale beef, and HRI beef sales. I'll say again, because of those imported cattle, our members are selling at a $40 head discount, but because there's no mandatory reporting on where that product goes into the HRI business, we're not convinced that the packers are suffering a $40 a head expense in trying to handle those cattle. So we would like to have the data to work on that one. And then the last point I would make is because of the recovery in beef exports and larger imports and recovery of exports since the BSE occurrence in December of '03, I think it's critically important that we get an expanded recovery of short-term export sales and imports, that we can more timely measure that flow of product in and out of the whole S&D balance table. And implementing these changes in mandatory would make it more user-friendly and would provide a needed degree of flexibility that would enable MPR to be much more responsive and improving the transparency for all market participants without radically disrupting the entire marketplace. Thank you very much.
Thanks very much, Don. I appreciate that. Neil, let's hear from the pork side.
Thank you, Mr. Dunn. If it's okay with you, I submitted written comments that you have, and I would just as soon shorten it up, take a hint, and maybe move on and give everybody time for questions. A couple of things. One, and actually, I was told this was going to talk about price reporting, not structure, but it's going to be difficult to not talk about the structure of the industry as we talk about reporting. And I liken back hearing Mr. Farley this morning when he talked about he never wanted to see his industry basically have his market short the entire production of the industry in a 3-day period of time. Commissioner Dunn, unfortunately, I know you were in place at USDA, and I was working with producers in the fall of 1998, where we saw literally for 3 weeks a panic. Done differently, but we swamped our production capacities, and that's where Mr. Johnson talked about $8 hogs. The point that went with that is that is, as he said, a major driver for why producers have chosen to look at other marketing ideas as far as to ensure and deal with some of the risk in the marketplace, which is taking hogs out of the spot market. Now, in my comments, I have references to the fact our council and our committees have been looking at this issue for some time. In fact, as recently as this summer, we had some noted economists visit with us, and we asked the question, we've been watching the spot market on negotiated numbers decline over time, and is 5% too thin for confidence in the market? And the response was, we don't know. They did make the point that, well, just because a market is thin doesn't mean that it doesn't necessarily properly discover prices. So the next follow-up question, of course, was, okay, well, when will we know it's too thin? And the response was, well, when people start using other mechanisms for pricing. Well, a ramification of the spot market on the negotiated side is obviously, as Paul talked about earlier, it's a function of the CME's formula for settlement, for cash settlement, which is critically important to our industry for risk management. And as we look at it, obviously the fluidity of the markets. Now, there's other things going that I could make an argument that would maybe do away with our spot market very rapidly, but the reality of it is right now I'm picking up, and I've had a lot of discussions with producers, and been involved in several meetings with producers, that there's an awareness of this issue by producers. They, of course, moved to formula pricing as a price volatility mechanism to reduce volatility and some risk. And now they're seeing the point that, well, if I'm not participating in the spot market, I'm not helping set the price. And I'm actually quite heartened since this last March at our annual meeting of producers saying, well, I'm willing to take some time and negotiate into the marketplace. I don't think we're going to see any move from 5% to 10% overnight, but I do think there's a growing awareness by producers because of the concern that we want to make sure we have options here. Now, with that, and Warren talked about it, it's been talked about earlier, and obviously as late as yesterday when the Senate Ag Committee approved the mandatory price reporting bill, it does include, as was talked about, mandatory wholesale price reporting, which for the pork industry is very intricate because as a species, we have the most differentiated carcass that's sold in different ways in the largest percentage of the carcass that is processed. So it's going to be very intricate process as we move from voluntary wholesale price reporting to mandatory wholesale price reporting to capture from the product and extrapolate back to cutouts. But again, critically important for the exchanges because the cutout is also part of the settlement or the formula for settling prices. All that being said, one of our concerns has been, we've been concerned that the live hog market's is thin. I think the voluntary wholesale market is much thinner and it's being used. And in fact, we've had producers that have used it as price discovery mechanism in these contracts for their own volatility. Thus, we're anxiously supportive of getting wholesale mandatory pork price reporting in. And again, kudos to AMS and to Warren, your staff. We have had an excellent relationship in the 10 years there has been mandatory price reporting. With that, the only other comment I would make, I did hear, I think somebody said that packers can choose to report under mandatory live price reporting, and under they're required to report twice a day, and again the next day. There are some issues in the industry with producers because they look at some differences on what the market does in the morning report versus the afternoon report, but producers seem to be figuring that one out. So with that, I will end in saying that there is one piece of information that, if it's okay, I'll forward to your attention, Commissioner Dunn and Chairman Dunn, and that is a study that was done by USDA, by Mr. Ted Schroeder, some other economists that actually looked at some more of these issues, and it might be some use as we move forward into this. So thanks for the time, and I'm open for any questions.
Well, thank you, Mr. Dirks. And I've got just a preliminary question because, Harry, you had said that negotiated price can be canceled after they're reported. And how prevalent is that, and how much of an impact does that have?
Well, the two parts to that question is the impact that it has is that it's all about weighted averages and that SPMF category that's in the MERC calculation. There's some, you can use math to get to that, I guess is what I'm saying. If 50% of that SPMF category refers to the negotiated Western Corn Belt price, the impact is going to be weighted each day. So if you have a day where, say, 80% of the SPMF category refers to the negotiated market, and a high ranged price in the negotiated market, either on the high side or the low side, gets canceled, all those contracts that priced off of that Western Corn Belt are essentially inaccurate for that day or maybe the next day. It's that unknown percentage that it's hard to categorize, so the impact is hard to get exact on. There's ways to get to that, but I can't speak to any of those specific percentages in this meeting. Does that answer your question?
It does, and I think it gets to a point that Don made in his written testimony, that the need for transparency here is just extremely important for all of us. But then it gets to my larger question, and that is the nexus between the futures price and this shrinking negotiated price. And Neil hit the nail on the head. When does it become an important factor, and how do we know it at that time? And I'd like to have all of the panelists discuss that, because I think it's extremely important that this contract that is so important to all livestock producers. Since it's your contract, I may start with you on that.
Okay, fair enough, fair enough. Well, from our standpoint, I'm going to refer to guideline number 1, which drives the requirements for all futures contracts, for those of you who may not be familiar with it. And one of the parts of guideline 1 is that cash settlement, must be at a price reflecting the underlying cash market. Well, in the case of the hogs, since we're using mandatory data, we trust that, and since we're using mandatory data on roughly half of the hogs that are transacted, and I'd say almost all of the hogs that are done on some sort of an arm's length arrangement, so it doesn't have other side conditions that might affect the validity of the data. But since we're using all of the best data that are available, we're confident that our contract does in fact reflect the prices that producers are actually seeing out in the country. Maybe not every last one of them, but in total, I believe that's the case. So
So that's one of our requirements. Other things that might feed into this are questions like, well, are those data accurate? Well, they're mandatory, so I believe that they are. If they aren't, Warren, you've got a problem. And then if the cash prices are being distorted in some fashion, well, we really have no way of knowing that. So, Jay, I think that's your problem. So this is a very complex issue.
But
So-
Paul, doesn't that become a futures problem if the cash price actually manipulates the future price?
Well, that's the assumption.
I mean, that's the nexus here, and the
but
reason why
again-
we're having this.
But fair enough. But again, there's a lot of things that we don't know. We don't know what the percentage of Western Corn Belt based formulas are in the SPMF category. Do we? Do we have a percentage? Either one.
No,
No, we don't.
Well, I can't answer that in this meeting.
Okay. So that's just one example. There are a lot of the inner things that we don't know. But at a high level, yes, I think we're doing the best we can with what we have to work with.
I think the first thing that I would bring up on this point is, as anybody knows, the economic performance of cattle feeding over the past 3 years has been less than stellar. And as we have seen this enormous erosion of equity in the industry, the covenants of the loan agreements have forced hedge protection. So that's caused a huge increase. The last point that I would bring up on this is that we talk a great deal about the escalation in open interest because of the fund activity over the last several years and how those increased that open interest has forced those fund positions to roll further and further into the deferreds. That escalation in price premium in those deferred contracts is exactly what has enabled cattle feeders, the loft in those deferred contracts, to profitably hedge. So, I'm not going to say that the escalation in outside money isn't a double-edged sword. It is, but the positive side of it is it has provided tremendous opportunity in those deep deferreds.
Jay?
Yeah. Well, anytime that the market has become thinner in a concentrated industry, makes the opportunity that there could be potential for manipulation or effects in the prices on a spot market. And we do have specific Section 202E of the Act that prohibits any firm from engaging in any practice in the course of their business with the purpose or effect of manipulating prices. And I will say that, that is one area that we do take very seriously, and when we have allegations of price manipulations, that we actively pursue them.
Harry?
Yeah, I'll go next. In surveillance, much like packers and stockyards, we're very concerned about powerful market players. Our surveillance programs are designed to detect and act on situations that are concerning to us. So these trends of increased concentration in the packing industry, as well as vertical integration, have changed things for us. And the example that I laid out in terms of the negotiated market that determines what all these contracts are priced at has us raising some flags, and that's why we're here. So I think this is an appropriate forum to discuss that trend, that possibility, and where do we go from here. So it has our attention from a surveillance perspective.
Warren?
Let me just comment briefly on this, the issue of canceled negotiated transactions. I guess our view would be that those are aberrations. We don't see those very often. And I know that we have shared data with both the CFTC and with Packers and Stockyards for their investigations, and perhaps they have a different viewpoint on that. But at least in our audit of the program, we haven't seen that those negotiated prices get canceled that often. I guess in terms of price discovery, I think I'm very encouraged to hear Neil mention that we do have producers who are looking to get into the spot market. because there needs to be a place for price discovery. And I do agree with the statement that you don't necessarily have to have huge volumes to have efficient and effective price discovery. I do agree with the concerns, though, that when you have big players, then small movements by big players can have big ripple effects. That's not really a price reporting issue per se, but it obviously spills over into CFTC and Packers and Stockyards issues. We go in, we look at the markets. We feel like our coverage of the negotiated wholesale pork trade is fairly complete. We think we're probably getting 75 to 80% of that market, but it's very thin. And one of the things that we think that mandatory gives us is that you do have that assurance that there's no selective reporting. We get everything. So even though those markets may be thin, at least we are getting the assurance that we have everything. The double-edged sword, though, that Don mentioned comes into play here, too, is that I think as the industry becomes more and more confident that our prices are accurate and replicable and meaningful, then they're willing to use those for formula trades. And then they go out of the negotiated market, and then there's nobody left to make the market. And that's where I guess I think that if it gets to the point where people don't believe in the negotiated prices anymore, they'll just have to go to some other fixed price contracts or some other vertical coordination types of arrangements if they completely lose confidence in the reported negotiated prices.
Neil?
About three quick things. One, to Don's comments, exactly right. The pressure from lenders on risk management is a powerful force for the producer on what your options are. Also, with that, a little bit to Warren's comment and to Don's earlier comment, as we take a look at how mandatory price reporting is reauthorized, we were advocates that 5-year reauthorization is appropriate. There were some that wanted to make it permanent. And we think it's important to visit these issues, like I would commend the advisory committee for visiting them now and being aware of them, because some healthy skepticism is a good thing. With that, I'd also, Mr. Johnson's gotten this lecture from me in the past. I will submit it to you, Mr. Chairman. As a producer perspective, we expect the referees to be doing their job. And I realize you might not be able to talk in an open forum, but the point being is that what we all need is a transparent, open marketplace that we have faith in, and if there are dangers, they need to be addressed.
I appreciate that. Sometimes you have to tug on the referee's jersey and make sure that they're observing when something has gone amiss, and that's what we're about here.
Well, if I could be so bold, Mr. Chairman, I would suggest we'd like to see lots of referees that, like the umpire that cost the guy the perfect game this summer, that actually recognize that sometimes we get in places, but as opposed to the referees that cost the U.S. soccer team its goal at the end of work. But we appreciate that, and again, the importance of it does need monitoring. Thank you.
Commissioner Summers?
I just have one quick clarification from Mr. Close on your recommendations that are in your testimony. I think some of them may need statutory change and some of them may be administrative, but of the ones that would take a statutory change, were those included in what was marked up by the House and the Senate? They were not.
No.
Commissioner Chilton? No. Well, I'd like to thank this group, but what's apparent to me is it would really behoove us to, as Congress goes into the reauthorization this September of mandatory price reporting, for the futures industry as a whole or individually, to make recommendations so that we can be assured that we have everything out there we need to ensure that we've got a viable futures industry. And I know you're going to be doing that individually, but I think collectively it would help as well. Let's open it up here for the advisory committee, and Kevin, we'll start on your side over here if you've got any questions.
This has all been an education on the livestock side for me, so I appreciate your presentations today. Thank you.
Okay.
We look forward to mandatory dairy reporting.
John? Well, thank you all very much, and again, I think it would behoove us to take the opportunity that's coming up here this September and make sure that, and I'll be talking to my fellow commissioners along with Harry about anything that we think we ought to be telling the various committees in the House and Senate to ensure that we've got this ability to have a futures market that works. With that, I would like to, is Don Heitman here? Oh. There's Don hiding behind here. This is the absolute final things we've got on in here today. Don is going to go over an overview of what the new financial regulatory bill has to offer for us in the area of agricultural swaps. And Don, it's yours just as soon as you get in the chair and pull up your presentation.
Commissioner Dunn? Commissioner Dunn, can I ask the CME guy a question before you? I just have a question for the CME.
Paul?
Is there anything in your arsenal that justifies that electronic trading may be doing more good than more harm than good because of the fact you don't have the visibility, the transparency doesn't exist? Is there anything, as a trader, I like the electronic process, especially when the way we get fills and everything, but I have a concern that it impacts, that part of the issue is the lack of visibility and being on the floor and recognizing that transparency issue and seeing who's executing the trades and making, even if it's the wrong identification, you do at least have an ability to identify or assume who's representing who on the floor. Any comment on that?
No, I really don't have any comment on that, except to say that the bulk of the trading is now on the electronic Globex platform, and that offers some advantages that you actually don't have with the floor traded environment. For example, on most of the trading front ends, you can see a portion of the book, either the top 3 or top 5 bids and offers. So if you're planning to execute a substantial trade, substantial volume, you can see where the air pockets are. So you know where the next bid or offer is, rather than just step into a hole. So there are some advantages and disadvantages to each venue, and we've chosen to just let the marketplace decide where they want to conduct business.
Anything else, Hager?
Just so you know, Commissioner Dunn, I accept that as a commercial. I accept that, but as representing a farm organization, that is a real concern of many farmers, many farm organizations, that the electronic process is doing us more harm than good.
And I think that is a concern that we have had when I came on as a commissioner in December of 2004. There wasn't hardly any electronic trading. It was all in the pits, and today there's hardly any pits, and it's all electronic trading. I recently had the opportunity to visit the CME and looked at their old trading floor, which is now all of the monitoring that they do of the electronic trading. And I'm sure they could arrange something for you and the Grange or anybody else that wants to come up there to take a look at that, because but that type of you know, we're very well trained here at the CFTC to look at pit traders and make sure they're not doing anything. We've had videos trained on them and all kinds of other things. Well, that's out the window now. That's the bygone years, and your point is right, spot on, that the electronic trading is something that we've got to gear up for. Fortunately, Congress did give us some additional money to gear up for the new laws developing our regulations, and let me defer to the chairman of our technology committee and let him talk about what we're doing in that area.
I don't think we ought not waste any time to get on with Don here, but the trading styles and monitoring trading is very important in adapting to new trading techniques and practices. That is something that we are looking at, trying to understand what impacts they are having. The concern about whether we're not going to put this back in the bottle, this genie back in the bottle. We're going to more and more electronic, and it is evolving, and we need to be prepared to address it face on any trading styles, behaviors, et cetera. We need to understand that, because we can't, as Chairman Dunn said, go back to the old enforcement styles that we had. We need to adapt and use technology in a much more significant way. Let me leave it at that, and let's get on with Don here and go from there.
If I could just make one final comment, and Chairman, I want to pick up on your statement of your tour. I'd like to extend an open invitation to anyone here, anyone on the committee. If you want to come in individually or bring a group in, we would love to take you down and tour this facility that Chairman Dunn referred to. We affectionately call it Mission Control, because it is just breathtaking. So we're very proud of it, and we'd love to show it off. So please come visit us.
You all will probably understand a lot more than I did, too. Don, if we can get you to go through.
All righty. I'd like to start out with just the standard disclaimer that we've got a bunch of interdivisional teams working on various rulemakings that came out of the Dodd-Frank bill, and I'm in charge of the Ag Swaps team, and we're just at a very early stage, so anything I say here is kind of preliminary and subject to change, and the opinions are my own, even not necessarily my own. And I have one more disclaimer, and that is one of our team members is Nicole, and you saw Nicole earlier give an example of a really good PowerPoint presentation. This is a terrible PowerPoint presentation. There's way too much information crammed onto every slide. My intent is that by the end of this presentation, you will be so hopelessly confused that you will actually look at the hard copy and read it, because there is a lot of good information in there. But
Some of us are already there, Don.
I'm going to be going through it at warp speed. So, looking at an overview of Dodd-Frank, some things don't change. The forward contract exclusion doesn't change. If a wheat farmer goes to his local elevator to forward contract his crop, that's still excluded from the CFTC's jurisdiction, and Dodd-Frank doesn't change that at all. The rules for exchange-traded futures and options aren't going to change, because exchange-traded futures and options are excluded from the definition of a swap. However, the definition of a swap is otherwise extremely broad. It includes not only traditional swaps, including ag swaps and commodity swaps, but also options of any kind. Any kind of an OTC option is now a swap and is going to be covered by whatever rules the Commission does for swaps. And as far as agricultural swaps go, the bill says any swap in an agricultural commodity will be prohibited when Dodd-Frank takes effect. And the next slide has got the timeline in it. Unless it's traded pursuant to an exemption under Section 4C, which is the Commission's general exemptive authority. and anything that's already under a 4C exemption is grandfathered. So the effective dates of Dodd-Frank, some provisions are on a shorter timeline than others. The general timeline is the provisions take effect in 360 days from July 22, but speculative limits for exempt commodities have a 180-day deadline, and speculative limits for ag commodities have a 270-day deadline. What kind of transactions are going to be affected by the ag swaps provisions of Dodd-Frank? There's basically four things. One is OTC agricultural swaps that are currently trading under Part 35 of the rules. They're grandfathered and they may continue for now, but it is anticipated that whatever we do by way of ag swaps rules would substantially revise or possibly completely replace Part 35. And it's not hard to figure out why that is, because the way Part 35 is drafted now, it would not allow cleared swaps. And obviously the Dodd-Frank bill has a preference to push things into the cleared environment. So Part 35 is almost certainly going to change substantially. Another ongoing kind of transaction are cleared swaps, like, for example, the corn and soybean basis swaps and calendar swaps that are already trading on the CBOT, and those, in fact, are also subject to a 4C exemption because they couldn't trade under Part 35 unless they were exempted, because the basic Part 35 rules don't provide for clearing. So those, the corn and soybean basis swaps and calendar swaps are grandfathered, but any new similar cleared swaps would likewise have to have a 4C exemption. The other two categories of transactions that are going to be covered are options, ag trade options, and there's basically two classes of commodities that are going to be covered, and one is the traditional enumerated commodities that are listed in the Act: wheat, corn, soybeans, livestock. And there is actually a whole set of rules in the CFTC rule book for trading agricultural trade options, and as people that have been on this committee for a while know, if you've been to previous meetings, the Commission's ag trade option rules have been a complete and total failure. Only one firm ever registered as an ag trade option merchant, and they withdrew their registration after a couple years. So the only trade options in the enumerated commodities that are currently trading are pursuant to an exemption in those rules. And the exemption basically says that you're exempt from the ag trade option rules if the buyer is a commercial, a producer, processor, merchant handling the commodity, and the buyer is using the transaction for hedging, and both the buyer and the seller have to have $10 million net worth. And the other type of agricultural trade option, what most people would think of as a trade option in an agricultural commodity, involves agricultural commodities that are not enumerated and not on that list in Section 1A4 of the Act. And those, the obvious examples of those are coffee, sugar, and cocoa. And coffee, sugar, and cocoa trade under the basic trade option provision that would likewise apply to petroleum or gold or anything else. And that's an even simpler requirement. The only requirement is the buyer has to be a commercial, again, hedging, using the transaction to hedge, and that's it. There's no financial requirements for those trade options. And all of those agricultural trade options are not covered by a 4C exemption, and they are not grandfathered, and they will become illegal when Dodd-Frank takes effect unless the Commission adopts some other rule under Section 4C. So how do we approach any exemption for ag swaps? The ag swaps rulemaking team, we're shooting for publishing proposed rules for ag swaps in November. And they, again, we have to do it under the Section 4C exemptive authority. And one of the, so for example, there's a public interest test in 4C, and so they have to be consistent with the public interest. But more significantly, the most significant requirement for ag swaps is, like all OTC swaps, OTC agricultural swaps could only be bought by eligible contract participants. That's OTC. Now, if it's a swap that's listed on an exchange, then anybody could trade that. But if it's an OTC swap, it could only be purchased by eligible contract participants. Who is that? Eligible contract participant would generally include large institutional or commercial traders, and as far as agricultural producers go, that's going to be the subcategory within ECP that's going to fit farmers is a corporation, partnership, proprietorship, organization, trust, or other entity that, one, has a net worth exceeding $1 million, and two, is hedging. And that's who would be an ECP, and that's who could purchase an agricultural swap. The other category that might apply would be just an individual with amounts invested on a discretionary basis, the aggregate of which is in excess of $10 million or $5 million if they enter the transaction for hedging. And I'm not sure what the hell that's supposed to mean. The Congress stuck that in there when they, as part of the Dodd-Frank bill. The major policy issue that we're facing in trying to come up with an ag swaps rule is that Congress, when Congress said, CFTC, you can only adopt an ag swaps rule if you do it under 4C, that seems to imply that farmers and other persons trading ag swaps should be subject to some kind of additional special protections beyond those available to people trading swaps and other physical commodities, because there's a little bit higher threshold for a 4C exemption than for a normal rulemaking action. So that leaves us with the question, should OTC agricultural swaps be subject to any special conditions or protections beyond those that would apply to OTC swaps in other physical commodities? And if so, what should those protections be? More restrictions on who can buy, more requirements for who can sell, or some other type of restrictions or conditions?
Don, can I ask a quick question? On the relationship to an exemption under 4C and Part 35 rules, is there any guidance there that might answer this question about special protections that you can think of? Did we condition the Part 35 in any special way?
Not off the top of my head, Commissioner. Part 35 originally wasn't even put in with agriculture in mind. Part 35 was put in 1993, and it was the exemption for all swaps. And then when the CFMA came and and the CFMA basically pulled everything else over into Section 2G, exempted all the rest of the swaps business, and Part 35 was just leftover. Agricultural swaps were all that was left because agricultural commodities couldn't be traded under 2G, under the swaps exemption that was in the CFMA.
Let me inject in here, Don, if I can, because these two questions that you're raising here are really important for the Ag Advisory Committee to have input on. And as I said at the beginning of this, that you can go on our CFTC.gov.
Commissioner, you're stepping on my presentation.
Okay.
I've got a whole big pitch for this.
Oh, okay. Continue then.
Alternatively, rather than making ag swaps subject to some special protections, should ag swaps be allowed to trade subject to the same terms and conditions as OTC swaps and other physical commodities? And really, it's a balancing act. Do we want to give agricultural producers additional protections and restrictions on swap trading, so to avoid the kind of a situation that people got into under hedge to arrive contracts, where people got into contracts that they didn't really understand, and nobody really understood the potential implications, and a lot of people suffered serious financial harm? Or alternatively, are we concerned that if we put extra bells and whistles on producers' ability to trade ag swaps, are you denying them opportunities to hedge their risks that they need to in their farming operations? So that's the question, and that's one of the questions we're going to be asking when in the proposed rules, and we certainly hope that when those proposed rules come out, and again, we're shooting for late November, that the members of the committee will comment. And in the meantime, if anybody has any preliminary thoughts or suggestions, there is a special Ag Swaps web page on CFTC.gov on the Commission's website, and the very last slide has a MapQuest map of how to get to that section on the website.
Don, I hate to interrupt again, I got to run to another meeting, but I'm curious as the relationship between ag swaps under either the exemptions they have, and I understand the current exemptions are they're exchange traded but not cleared.
The current conditions, there are 4 conditions for agricultural swaps under Part 35, and I can't give you all 4 of them off the top of my head, but one of them is that counterparty credit risk is not a material consideration, or I'm sorry, is a material consideration. And so if it's a cleared contract, you don't care about counterparty credit risk because the clearinghouse is standing in between. So that effectively means that an agricultural swap under Part 35 couldn't be cleared. And there's another one of the 4 is that it can't be fungible, and that's another. So that again would take you out of clearing, which is why when the CME group came in with the calendar swaps and basis swaps, we had to give them that they wanted to, clear OTC calendar and basis swaps. They wanted to clear on the CBOT. The only way they could do that is if we gave them a 4C exemption from those provisions of Part 35.
Let me ask, my question is, what is the relationship between the 4C exemptions we have, or the Part 35 rules we have today, and what we're doing in the policy decisions we're making regarding energy products under the Clearport model, where we have blocked in, they're not exchange traded, but they are cleared, and we're trying to understand what the future of that exchange will be going forward. What is a policy relationship? Are we trying to tie those together?
You just exceeded my area of expertise, Commissioner, because I haven't been involved in that part of the Commission's mission.
Fair enough. Thanks.
So another part of the Dodd-Frank bill says that another part of the actual ag swaps provision says that they apply to any swap in an agricultural commodity as defined by the Commission, which means that, and for the first time ever, the CFTC has to publish a definition of the term agricultural commodity. And the ag swaps team is also doing that. And that is actually on the 180-day deadline, because the spec limits for exempt commodities apply to, well, under Section 1A14 of the Act, an exempt commodity is a commodity that is neither an excluded commodity nor an agricultural commodity. And there's only one term in there that's defined in the Act, and that's an excluded commodity. So if you want to have spec limits for exempt commodities, you've got to define agricultural commodity, so you've established the boundary between agricultural and exempt. So the ag commodity definition is on that 180-day deadline, and what we're hoping to do is that we would actually publish the agricultural commodity definition in the same issue of the Federal Register as the proposal to establish spec limits for exempt commodities, which would be things like oil and petroleum and metals. And then you'd cross-reference the two definitions in the Federal Register. And in terms of what the definition is going to be, we're generally trying to draw a line between products that are derived from living organisms and are used for human food, animal feed, or natural fiber, which would be covered by the definition, and plant or animal-based industrial products, things like butanol or denatured ethanol, which would be outside the definition. And so again, we would hope everybody would be on the lookout for the proposed definition rules, those should come out around mid-October, and we would hope to get your comments. And then the ag commodity definition would also be used in the speculative position limits contract, because Dodd-Frank requires the Commission to issue spec limits for agricultural commodities, and that, as I think has been mentioned multiple times, including just now, is a 270-day timeline. And again, when those come out, we would love to have comments from the members of the Ag Advisory Committee. And in the meantime, we don't want anybody to wait until these Federal Register rulemaking proposals come out. By all means, if you have any preliminary comments, we would love to hear them, and this last slide has a link to the spot on the CFTC website where you could submit your comments, and alternatively, there's a little roadmap of how to get there. Go to the CFTC website, and shows you what drop-down menus to click on, and you should. When you finally get down it, you'll come up with something that will just have a little email address that says agswaps@CFTC, and by all means send us an email. And that's my presentation.
Any questions or comment to Mr. Heitman?
Just a question. Any comment on what impact this would have on farmer-owned cooperatives as they try to originate grain and compete with the larger international companies in this area?
I don't even have an outline of the proposed rules yet. So, I mean, but please, if you got any thoughts on that, send them to the website. But I mean, literally, we're just at the very, very early stages of drafting, so I can't predict anything that's gonna be in the rules. And anything we do put in the rules, that's just a staff proposal. The commission makes the final decision, obviously.
The last point that Don made is that they make recommendations to us. But it's much better if they hear from you early on what you'd like to see in there, to ensure what you'd like to see in there are part and parcel of that recommendation. And that's why I said in my opening statement was so important to take part in this. And I really appreciate, Don, the roadmap there on how to get into it.
Yeah, I do have a question. It was my understanding as I looked at at least the pieces of the bill that I was asked to look at, that there were very broad exemptions for end users, which included producers, ag producers, from requirements for clearing and I thought regulation generally. But if I understand you right, these swaps are basically going to require reporting and regulation of all sorts of farmer transactions. Is that right?
Well, the traditional, forwards and exchange traded items aren't going to change at all. The rules for ag swaps, one of the questions is, would they be treated the same as other swaps transactions, or would they have some special different rules? But the agricultural producers are not going to be exempt from there's going to be a basic requirement of who can trade agricultural swaps, and that's going to be eligible contract participants. And so farmers are going to have to fit into one of those categories, and as I said on one of the slides, the logical category that you would expect a farmer to be able to fit into would be $1 million net worth and hedging, and it's corporation partnership or some other entity like that, as opposed to just an individual.
And both sides have to be eligible swap participants?
Um,
I'll give you an example. It's my understanding that there's a large processor that is trying to do some price hedging by basically doing swaps with producers that are not necessarily delivering milk to their plants. As I understand from your presentation, would be an agricultural swap that would be subject to all this regulation. Now,
I mean, we haven't read the rules yet, but I'm any large commercial that's on the other side would almost automatically be an eligible contract participant. A big co-op or a big business would meet one of the tests.
so that's still a question then, whether both sides would have to be eligible, or you're saying just
Well,
one?
no, I'm
one
saying,
side?
yeah, no, I was just, in this context, I was trying to look at it from the viewpoint of agricultural producers, but, and you'd have to have an ECP on both sides, but.
On both sides.
But, yeah, the seller's side it'd be hard to envision somebody that would be a big commercial firm offering swaps that wouldn't qualify as an ECP.
But you're saying both sides would have to qualify?
Yeah, I mean, the farmer has to qualify as an eligible contract participant as well.
With assets over $1 million?
That's what the statute says.
Okay, thank you.
Yes.
Thank you for that presentation, Don. Did a good job of outlining what your rulemaking group is doing. We've gone through the bill and picked out a handful of rulemaking areas as you've defined where our co-ops have interests, and we appreciate having the opportunity to weigh in the process and look forward to doing that shortly. Now that we know who you are, I'm hoping that we can maybe find out some of the other individuals in those different rulemaking areas so we can start providing input.
If you will follow that roadmap that Don has, or what I said in my opening statement on how to get in there, it will give you an address to the persons that are making those changes. They're writing those rules, so you're going to have direct input to the staff, and there are 30 of them you'll see when you get in there, I mean, I feel sorry for these folks because they've got deadlines that they've got to do, and they've got to do their regular jobs as well. But that gives you the ground floor. And what I will commit to the members of the advisory committee is I'll have my staff let you know when key thresholds are coming up so that you can get in there. But it's in your own best interest to go in, take a look at those 30 areas, find out what you are interested in, and before, as Don says, he's grappling with all of this stuff. He's as they begin to take pen to paper, now is the time to get your concerns in there, because believe me, it's a lot easier to get them in early on than after something is written. So this is an opportunity, and as the chair of the Ag Advisory Committee, I want to make sure that you all have as much input as you can into this major watershed and the way the commission operates.
And I'd just like to second that, because just speaking from the perspective of trying to put these rules together, the better you guys understand how your business works better than we ever could. And we're trying to write rules that make sense for your businesses. The better we understand your issues, your concerns, your problems, then the better we are able to write a rule that makes sense and works for you. So again, the more background information we can get, the easier it makes our job, and the better the rule's going to look from your perspective.
Don sometimes is a stand-up comedian, and he's milked a laugh, but he's never milked a cow. So those of you that have, it's good for you to give some information to him. Well, with that, I want to thank all of you. I want to thank my commissioners that we ran way over our time, but these were very, very important issues. And I want to thank, as always, the Ag Advisory Committee for you giving up your time coming in today. But we've got a lot for you to do in the future. And anything that you think we ought to be conveying to the agricultural committees as they begin meeting their deadline on the mandatory price reporting reauthorization. Oh, Bart is back on the phone. Is that understand? Am I right?
Yeah, but I don't need to say anything. Thank you for everything, Mike. Thank your staff, and thank the committee members.
Oh, thank you very much, Bart, for staying with us. The good thing about being on audio only, he could step out and have lunch.
Yeah, I wish that's what I was doing.
Once again, thanks all of you, and this is going to be very helpful for us. We've got a very, very busy time in front of us, and we're going to need your help. Thanks.